All right, we are back in the Fireside PM podcast, and I have a very special guest today, Craig Sherman, partner at Wilson Sonsini, and an attorney that I benefited from your counsel for many years as a startup founder, and we've just kept in touch ever since. Welcome to the show, Craig. Why don't we start with a introduction to yourself?
Great. Well, Tom, it's great to see you again. And Tom and I go way back to working on Yably, among other things. And I would be wearing my Yably T-shirt today if it weren't in the laundry because I wore it 3 days ago. I messed up my schedule and I should have planned better. But that shirt has been all over the world, proudly worn last in Cairo.
That's great to see. Great to see it lives on.
Yes, it does. Even though if the startup is gone, the T-shirts live forever.
That is so true. Hopefully my next one will get a little more than a T-shirt out of it.
Yeah, we all whatever return we can get is great. If it's beyond a T-shirt, that's even better. But T-shirts are awesome too.
So tell us a little bit about your role. Like, what do you do for your job?
Yes, so I am a corporate securities lawyer. I'm at Wilson Sonsini. I've been a practicing lawyer for about 35 years, but focused almost exclusively on representing startups for the last 30 years. So what I love to do is get involved with companies from the very earliest stage, ideally at incorporation, and work with them on their financing strategy and business growth strategy as they scale from 1, 2, 3, 4 people in a garage up to ideally a big public company, which has happened quite a few times, and we always love to see more of those.
And when they do, for the ones that make it all the way to a public offering, do you stay with them, or does it transition to a different team at Wilson that focuses on like IPOs and things like that?
Yeah, I remain involved throughout the life of the company. When the company gets to that stage where it's going public, I will typically add to the team other people who are more focused than I am full time on public company work. The 34 Act reporting, 10Ks, 10Qs that I know how to do, but I've been there, done that, and would rather have somebody else do it rather than me.
Yeah. And how did you decide to focus on this area of the law? Like, I'm guessing there's easier ways to get billable hours than working with startups.
Well, that's the thing that's what I like about doing this kind of work is that it's not about the billable hours. It's about building the relationship and working with the company over the long term. And if the companies are successful, then we're successful. We're not set up to and don't need to make a lot of money or make meaningful money off a company early in its life. We're really betting that the companies that we're working with will be successful. Not all of them will. That's the nature of the game. It's a portfolio strategy, like with a VC. But the ones that go public or get acquired or both have tremendous legal needs that really expand. And the great thing about the platform of our firm is that we can work with the company's early stage and we know how to be super efficient to do the kind of work that needs to be done early stage and do it cost effectively. But when the company gets big and needs a team of 30, 40, 50 lawyers to do a big M&A transaction or a big IPO, we've got the heft and the experience to be able to hand that on the later end as well.
Got it. So you guys, in a way, Wilson's like an investor to the extent that you're going to make a lot of bets on these early companies, and the one or two that really pan out, they kind of cover all the time you spent with the other ones.
That's exactly the model. And again, it's very similar to a venture capitalist model where they know going in that probably more than half the companies they invest in will fail and will be zeros, but it's the ones that are really successful that will make the difference. And we do that in part through the legal fees and the legal work that those later stage companies end up needing does become a lot more expensive, frankly, but market rates. But that pays off for that early investment we're making for the companies. And then often that investment is more than just an investment of our time and the risk we're taking, but it literally is an investment with
Mhm.
most of our clients. We do typically make relatively small investments in our clients alongside the investors who are investing directly in the companies.
Yeah, that's great. Certainly aligns a lot of incentives there. Um, how do you decide what early stage companies to work with? Because I guess you've got to put on your investor lens as well then.
Yeah, so we're doing a filtering process. We turn down a majority of the companies that approach us, where we just say it's not a good fit. That even if their legal needs are relatively small, it's not a good use of our time or the company's time if the company is never going to raise money. If it's just going to be a mom and pop business that where they incorporate and they're not going to raise angel money, they're not going to raise venture money, they're not looking at a big M&A exit, then we're not going to be the right firm because we're designed for high growth companies that are going to be transactional, that are going to be doing financings, are going to be doing M&A. And if it's just a small company, it won't be a fit. And also, there are a lot of people who want to raise venture money, but may not be able to. And we want to do a filter there. It's not going to be a perfect filter. We make mistakes. We certainly have worked with companies that never end up raising any money at all, and it doesn't work out. But we're looking at the same kinds of things that an investor, that a VC or an angel investor would be looking at. Is this a scalable business that can either turn profitable and have or not, or actually in most cases never turn profitable, but still have a great outcome? Because
Mhm.
most of our clients that are successful to the investors are successful because they end up selling typically well before they ever get to profitability.
Yeah. And you have seen these cycles come and go. And certainly it felt like 2022, early 22 was just bonkers. And I remember getting like recruiter emails every few hours. It felt like, oh, I'm working with this company that just raised, $80 million and yada, yada. We're not in that stage anymore. Tell
Definitely
me a
not.
little bit about what was it like from your perspective watching this happen? I'm guessing, you weren't quite shocked that, the pendulum swung.
No, not at all. I mean, 22 felt very much like 1999 all over again. And
Mm,
that prior party, for those of us who have gray hair,
yeah.
painfully remember that it was totally out of control. Same thing, recruiters reaching out to everybody, lawyers and accountants dropping like flies because they were just overworked.
Mm,
Everyone trying to hire in the services industry when the service providers that are needed to get deals done, the lawyers and accountants, can't keep up with the work. That's when you know that you're at a market peak and the wheels are about to fall off. And in 1999, the wheels absolutely were about to fall off. And that one built over a longer period of time where we kind of built from the early 90s to late 99, early 2000, where it just kept growing, growing, growing every year. And then
mhm.
it really accelerated in 98 and 99, where we were just crazy busy and companies were going public right and left. And that crash was worse than this one, the dot-com crash, in a lot of ways, because number one, nobody prepared for it. People thought that business cycles were over. The internet had changed everything, and that there was nothing but up. And there were lots of articles written in the Industry Standard and other publications that no longer exist, saying that the cycles were gone and we were in this infinite boom that was going to last forever, which clearly wasn't the case. But everyone thought money was free and you could raise money right away. And um, you just didn't need to worry about raising cash. I remember being in board meetings where the investors would say, we're going to pay everybody on the management team huge bonuses so long as you hire 250 more people in the next 6 months. I don't care what the people do. I don't care what their jobs are. just go out and hire 250 bodies, because you need to have more bodies, because we're going to go public. And in order to go public, you have to prove that you're a real company by having lots of employees. And so this company literally went to the campus on the University of Washington, went to the frat houses and the sorority houses, and hired every 19, 20, and 21-year-old they could find to work at the company. And then you'd show up at the company and people were just throwing footballs in the hallways because they didn't have a real job. They were getting paid, but they didn't have a job. They were just there so that the executives could earn bonuses. And then, it was musical chairs. The music stopped, and there was no more money. So companies started failing immediately when the market crashed in the spring of 2000. This time around, this boom in 22, there was a lead in, but the lead in wasn't as abrupt, or wasn't over as long a period of time. It was a brief period of craziness in the venture world, but even more so in the SPAC world, where all of a sudden in 2020, late 2020, in the middle of the pandemic, everyone in board meetings in venture-backed companies went from saying SPACs are stupid within probably a 30-day period to SPACs are the greatest thing ever. We need to merge with a SPAC right away because there's lots of money and that money is free. And so that's when we went truly crazy on the late stage investments. Every private company was raising 100, 200, 300 million dollars because the investors were piling into anything technology related that was venture backed, even marginally tech related. And then all the SPACs were happening. So people were getting liquidity during a brief period of window of time very quickly. But the big difference is everyone knew that this was stupid and wasn't going to last. A lot of people who had been through the disaster from 99 to 2002 that carried on even a while beyond that were aware that this was not going to last. Nobody was saying the cycles are over and we don't need to worry about it. Money's free. Everyone knew that they needed to raise the money while they could. And we went very quickly from the boom in 2022 to everyone saying, you got to have 18 months to 2 years worth of cash in the bank or else. So people did stock up on their cash. And that meant that the die out has been less precipitous. Yes. And there are companies that are still around. Now, some of those companies, arguably, maybe it's just delayed the period. Yeah. So there absolutely are still companies that are hitting the wall. But there are a lot of companies that had planned well enough that they've been able to get to profitability or extend out their runway even further. So there are a lot of walking wounded right now. There are a lot of companies that have been through multiple rounds of layoffs, but a large number of those, I think, will be able to survive and hopefully turn things around when the market at some point improves.
Yeah. I guess if they raised a bunch of money and then the music stopped and then they did a bunch of layoffs, they still should have decent runway to turn things around. I think maybe the biggest concern would be they might have raised money on a concept or on top line growth, but now they've got to actually get closer to like covering their own expenses with revenue, which is very novel.
Can be a real problem. Yeah. and not something that a lot of these companies expected because the traditional venture model is intentionally a series of stage investments where VCs are investing with not only the hope, but the expectation, the desire that the company is going to raise money every 12 to 24 months at an increasing step up in valuation. I think I went the wrong way on the screen. Which way is that going? This way, up and to the right. And that model is broken right now, where it is extremely difficult to raise a follow-on institutional round. There just aren't very many investors that are willing to write a check in a new company unless it's seed stage. So I think we have done more seed stage deals with quality venture capitalists in the last 12 months than maybe we've ever done. And so I'm super excited about the long-term prospects about a lot of these companies that have been able to raise very healthy seed rounds, frankly, at very healthy, maybe even worrisome valuations depending on the industry. But we've had a real problem getting that next round of financing, whether it's A, B, C, D, E, F, or beyond, because so few VCs are willing to write a check in somebody else's deal. Most of the VCs remain focused on taking care of the existing portfolio.
Mm. So help me understand that if I have some dry powder as a venture capitalist, and there's a company that raised a bunch of money in 22 that in an A round, and then it was at an inflated valuation, but they did a bunch of layoffs and they need more money now, and they were willing to take a big down round. Why wouldn't I be open to that? Because I could say, well, team's been around, they're functioning, they're starting to turn things around, versus some new seed opportunity that's not quite as mature.
Yeah, I mean, it's a great question. I think part of it is no VC wants to be the bad guy and provide a term sheet that's going to require recapitalization. That's going to be a significant decrease in the valuation from the last round. That doesn't mean it doesn't happen. That doesn't mean they're completely unwilling to do it, but it is something that they don't want to do unto someone because they don't want to have it done unto them. So that's a big part of it. I think there's also a worry that, well, if there's a next round that needs to follow, how is that next round going to happen? So there's just a general reluctance to pile into something that was a little bit of a mess, even if the mess has been partially cleaned up or even maybe wholly cleaned up. There's a little bit of a taint associated with it. So a lot of the VCs feel better about starting from scratch and doing something entirely new.
Yeah, it's like a new construction versus a fixer-upper.
Exactly. Yes, and there are a lot of fixer-uppers out there right now in the startup market, not in the housing market, but in the startup market, there are lots of them around.
Yeah. And so you talked about the seed stage is looking pretty healthy, and maybe even getting a little frothy. I guess, is that because nobody wants to put money into these kind of walking wounded, so it's all concentrating on seed, and I guess that's a good time to be a seed stage founder?
I think it is a good time to be a seed stage founder because a lot of these investors are looking for the new things and not looking for the fixer-uppers. So I haven't seen a better time to be starting a brand new company for a long time. And it's also, everyone always talks about this during every down cycle, that a lot of the best startups are founded during down cycles because it's easy to hire people. If you're not going to be a virtual company working from your home, then, and you're looking for office space, boy, office space has never been cheaper than right now. You can get it. You can get that basically for free these days because there's plenty of that available. So it's actually a cheaper time to start a startup. So it is an exciting time to be an early stage entrepreneur. And if you're in a company that's already raised a round and you're trying to raise a round now, that's a much harder life right now.
Yeah. What about the pre-seed phase? How is that looking with angels and stuff like that?
It's interesting because 10, 20 years ago, nationally, we saw lots more deals pre-seed funded by individual angel investors. And one of the big changes since that time has been the rise of a large number of early stage funds that are dedicated to investing early stage. And a lot of the LPs, the limited partners in those early stage funds, are the people who used to be angel investors. Or a lot of those funds were started by people who used to be angel investors. So we've seen a real shift from individual angel investors to kind of institutional angel investors. And I think that's been a good development in the market because these institutional angel investors, these small early stage funds, tend to be more sophisticated than a lot of the individual angel investors were. They're able to be more engaged and more involved in adding value for the companies they're investing in. So, and frankly, it's a lot more efficient to get a deal done with 2 or 3 institutional angel funds or institutional early stage funds writing $250,000 to $500,000 checks each than it
Mm,
is to go out and gather 10 to 30 angel investors putting in 50 grand each. So I
yeah.
think that's been a really healthy development for the industry. But it's actually when I look at the cap tables for our earlier stage clients, it is a dramatic change from the way that things used to work.
Yeah. And in this new kind of environment where um, investors are a little bit less enthusiastic in general, what are the metrics that people are focused on? You mentioned like I remember in 99 people would ask each other, well, how many people work at your startup as a measurement of its success, which was
Yes, yes.
this strange kind of thing. It's like, oh well, they don't do anything, but we don't have any revenue, but we have 40 people or something like that. What's the number that people are looking at now? Is it revenue? Is it profitability, or
I
what
think
is
it's revenue. I mean, earlier stage where there's no way there's that
Mhm.
the company's going to be profitable to begin with. It's revenue. It's maybe more importantly customer traction. Even if the checks aren't coming in yet, who are the logos, and what's the quality of those logos, and how much are they likely to spend? Are they going to sign up for long periods of time? So I think people are more focused on real business metrics, and then the scale of the business. The uh, is what is the size of the market and how big can this become?
Mhm.
Because there are a lot of companies out there that really aren't able to demonstrate that the market's ever going to be that large, and they're never going to be able to get beyond 5 to 10 million in revenue, even if they can get to 5 to 10 million in revenue fairly quickly.
Yeah. I was actually talking to Kirby Winfield yesterday, and he mentioned the logos being important to him as a pre-seed investor. I was curious, why do you think it's almost sounds as if someone with like three recognizable logos as customers is doing better than someone with like five or six customers who are paying some modest amount but aren't like kind of big names. But what's behind that?
I think it's part of it is validation, the assumption that a big brand name, a big logo is going to have done more diligence
Okay.
and may even be slower to sign up. But once they're signed up, I think the assumption is that they're likely to stick around long term because they've invested resources in working with a startup. And so there's a higher likelihood of success. But I've definitely seen this in quite a few startups, quite a few board meetings in the last few years where there's a discussion: should we go for three big ones or should we go for 20 small ones?
Right.
And the advice from the investors, and frankly, I think in this market it is good advice, is go for the three big ones and make them love you. Because if you've got three that you as the founders of the startup have really invested in, and those three companies quality logos are really invested in the relationship, you're much more likely to succeed than if you're going scattershot and you got 20 different companies that you're working with very early stage before you've even necessarily demonstrated fully product market fit. And you're going to lose a lot of the 20 because you can't pay attention to them in the same way. You can't bear hug them in the
Mhm.
same way you could bear hug three big ones.
And those three big ones, do they need to be paying, or they just need to be actively, repeatedly using your offering?
I think it depends on the nature of the business. In most cases, just actively um, engaged in the business,
Mhm.
even if they're not paying yet, but they're on a
A path.
trajectory to pay, and they're going to pay expected to pay meaningful amounts.
Interesting. And is it the convertible note still the lingua franca for how
Uh,
to raise money, or what's the
if
late?
convertible for how to fund early stage companies.
Yeah.
Um, we're seeing safes much more often than we're seeing convertible notes, and part of it is just the market's accepted it. It has the advantage that you've got the Y Combinator form that everybody knows, and so
Hmm.
you can do a simple red line, and everyone can understand what it means when you do a 30-second red line. You don't need to get lawyers involved. Convertible notes, there's not a huge divergence in terms, but there isn't one accepted standard form.
Mm-hmm.
And you can't underestimate for everyone involved, whether it's the lawyers, the companies, the simplicity, even though lots of lawyers think the safe form itself is not very pretty and it's not very elegant, but it's been accepted by the market and you can do that red line. The ability to do a red line that immediately shows you what varies from market
Mm-hmm.
is huge. And with a convertible note, you can't really run a red line because there's not an accepted market standard. And even though the deal terms, there's not a big difference between a convertible note and a safe. I mean, it's the convertible note, you got to have an interest rate on it and it's going to have a maturity date, but otherwise it's pretty much the same as a safe. And you're really otherwise just negotiating the discount on conversion and the amount of a conversion cap if there is a conversion cap. So they're largely the same, but I think people are increasingly more and more comfortable with safes, where I would say for an early stage company, 80 to 90% of the company at the time, where it's a choice between a convertible note and a safe, we're doing a safe.
I was speaking of valuations. I was talking to someone who was thinking of starting a company, and I've recently started getting into a little bit of angel investing. I feel like I got to give back to the universe a little bit.
Yes.
um, and so they were asking me like, oh, their pitch was like, hey, all I need to do is raise $500,000. I can build this team to do this thing. And I said, oh, but if you and your co-founder can bootstrap this and get a couple of pilot customers, it would be a much more attractive investment than, hey, you give me money first and then I'll build this thing. And then we talked about valuation. And I was like, once you get a couple customers, then you could probably go out and raise it like maybe at a $10 million valuation. And he was like, oh, why is it so low? Because it's an AI startup. And I was like, I don't know, maybe I'm like old school, but like if you
You're
only
old
have
school on AI, Tom. Yeah. I think for anything that's not AI, $10 million is a really good valuation in this market. Anything AI, I mean, it's funny how history does repeat itself, and it feels very much like 1999, where you slapped a .com on the company name and your valuation went up 20%. And in the, it's the same thing with AI now, that the market has really changed, and if it has a .ai, or even if you just say it's an AI business, and of course every software company is,
Yeah,
everybody's using AI these days. You can't run a business without using artificial intelligence in some
yeah.
way. But just saying that it's an AI company will meaningfully raise the valuation, and also, maybe even more importantly, dramatically increase the likelihood that you will successfully close a financing.
And are you talking like I could see that argument if you're working on something that fundamentally makes AI available to other builders, or it's it's like an Anthropic or an OpenAI or whatever. But if you're just using ChatGPT and skinning some stuff on top, are you really an AI company? Like,
No, but the market thinks you are, or some investors are likely to think that you are,
yeah.
and there is no question that the day of reckoning is going to come for these AI companies as well. And you've got a lot of copycats,
Hmm.
and you've got a lot of companies that don't really have a business plan other than we're going to use AI, or we
Hmm.
are an AI company, whatever that means. But there's a big leap from having a PowerPoint presentation that uses all the current hot buzzwords, which frankly
Hmm.
is how VC financings have worked for, at least the VC market has worked for 30, 40 years. There are always these fads and buzzwords. But a lot of these companies just are clearly not going to be able to find a business where they actually get paid, let alone ever show a path towards getting to profitability. And a lot of these companies are going to fail. And I think the current thought for a lot of investors, and we've seen this in other boom cycles before, is even if I, as an angel investor, invest in this AI business and it turns out that there is no business here and it's not able to raise the next round, we'll just do an acqui-hire. Somebody's going to buy the company in order to hire the engineers.
Mm. Interesting. And so for seed funding, how for seed rounds, you should have a few logos though, right? Like you can't just raise it with a team and a plan. Or really?
No, yeah, no, I've seen quite a few seed deals these days that have at very high valuations where it's two or three people in a PowerPoint presentation,
Oh boy.
which
That's
doesn't
scary.
and they're really investing in the people. Most of these
Yeah.
companies are companies being founded by successful serial entrepreneurs.
Mm-hmm. Mm-hmm.
So I've had one good exit, I've had two good exits, and the same investors are begging to
Right.
reinvest some of their proceeds from the last windfall that they had 2 to 5 years ago.
Right.
That's what we're seeing a lot of. Um, and again, even non-serial entrepreneurs, if they're in what's perceived to be a hot space, particularly anything AI related, they're often able to raise venture money without any logos and without meaningful code having been written.
Hmm.
So it's a
Wow.
bet on the future.
Yeah, indeed. I guess now that I'm writing some checks, I feel a little bit more kind of uh concerned about this. Like as a founder, it's like, all right, let's go. But yeah, I hope these companies are able to find a sustainable business model where they can get paid more than they spend at some point. And I guess
Yeah,
that's the hope, right? Yeah.
they're going to have to, or they're going to fail. And I think in the short run, it absolutely is true that a lot of these companies could exit as acqui-hires.
Yeah.
And you know, 10, 15, 20 years ago, lots of early stage companies that we worked with that were angel backed, raised $1 to $3 million,
Mhm.
but didn't necessarily get much business traction, would be acqui-hired by Microsoft or Google or Amazon. And you could have a really nice outcome for the founders where the company's being acquired for 10, $20 million, but you've only raised $1 or $2 million, and the investors get back, a 2x return on a 1 year investment or 2 year investment. And the investors are making millions of dollars each, and they're getting hired by the big tech company. Um, those went away for a while, those acqui-hires,
Mhm.
but we are seeing acqui-hires right now, absolutely in the AI space, where there are startups that raised a few $1 million, didn't get that much traction. And in a lot of cases, the founders decided, hey, company X or company Y is doing big, giant public company X or public company Y is doing great in the public markets. And I'm a believer that there's more upside in this stock.
Mm.
And I'm ready to join the big company or go back to the big company in some cases.
Mhm.
Because if they want to pay me, if I can collect 10 to $30 million up front for selling my company that I've been working on for 13 months, and then I work there for the next couple of years, well, that's okay. That's not
Yeah.
bad. I've de-risked this and guaranteed myself a pretty good paycheck at the end of it
Yeah.
at long-term capital gains rate.
Yeah. And I guess the acquiring company is going to get a team that has been building some AI capabilities, and they presumably can sprinkle that onto their existing products and get to market faster.
Yeah, and I think in some of these cases the buyers are buying the IP, but I think in a lot of cases with these early stage companies, they don't even care about the IP.
Mhm.
That what they really are buying the team, and they're going to put the team to work on something that in many cases is quite unrelated to what the startup had been doing.
Fascinating stuff, Craig. We're going to have to I can almost project a year from now we may have an interesting conversation. Like what happens to these seed funded guys that are going to need to raise their A's? Are the A investors going to be like, well, I'm still going to bet on the future? Or I would imagine at that point, they're going to have, like, if you just raise a seed, you absolutely have to be on a path now to figure out, okay, I'm going to need like 10 paying customers for the next round
Yep.
or something, right?
Yeah.
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 Um,
And I'm hoping, if and when we talk a year from now, that the market will have turned. And, we didn't talk about the Federal Reserve's role in this, but clearly interest rates are having a huge impact on the venture market. And a lot of dollars are moving out of venture to safer investments that are paying very high interest right now. And that's having a big impact on VC's willingness to write checks right now. They're holding their dry powder out for a longer period of time because they're worried that it's going to be harder for them to raise their next fund. And at some point that's got to give.
Yeah.
And there is still absolutely, and this happens in every down cycle. Everyone points out, well, the VCs have lots of dry powder. And that's true, but that powder is only so dry because it's not cash sitting in the VCs' bank accounts burning a hole in their pockets. They've got commitments from their little limited partners that they will invest in the future when capital calls are made. But in a lot of cases, those limited partners who invest in the venture funds are telling the general partners, the investing partners, don't make a lot of capital calls because we need more liquidity events first. We need to see more cash coming back to us before we're comfortable sending you fresh cash to make new investments. And so that will turn. It always does turn, and it's only a question of when.
Craig, how can people stay in touch with you or hear what you're talking about, outside of the next Fireside PM podcast? How can they stay in touch?
Yeah, I'm on LinkedIn, and so I post, from time to time. I try to stay up to date, post a lot about events that are going on and developments of interest in the startup market. So you could just look to my bio on LinkedIn and see information there. And I check in on a regular basis, and I'm always reachable.
And if a founder is looking for an attorney, what is the process by which they get considered by you and your team? How does that start?
Yeah, that's a great question, because you had asked me that sort of earlier and I didn't completely answer. I mean, we are filtering the same way that VCs are. We only want to work with companies that we believe are going to be successful. A large part of that is our conclusion that this company is going to be successful. And that's often tied to who the referral source was. So if a trusted founder we worked with before sends a company our way with a warm introduction saying, I've known this person for 20 years and they've been at Microsoft or Amazon or Google the entire time, and this person's a rock star and is going to do great things, and they're finally spinning off on their own and doing something new, that's much more interesting to us than a cold call. And we're, like a VC, going to be more skeptical of somebody who approaches us out of the blue of necessity, because we need to filter the companies that we could work with. We can't work with every company that approaches us. And part of that filter is having somebody in our network we know tell us, hey, I really believe in this person and I think they're going to do something great.
Great advice. Well, thank you so much, Craig. Maybe one last question. For a founder that's listening to this and they're just like, I don't have a warm referral, like, what are the characteristics of the cold self-referrals that you would actually maybe take a flyer on?
It happens very, very rarely that we will take on a company that is just a cold referral, where somebody just reaches out to us and we don't know them at all and we don't have any common overlap. Those rare cases would be somebody who's got a stellar resume, stellar background. A serial entrepreneur is something that we're always looking for, somebody who's done it before and has had a great success, or somebody who's been very successful in a big company and can prove to us that they've got what it takes to make that difficult transition from being a big contributor in a giant company to doing it themselves, because it's a totally different world. So the standard is really high, but that it's about the individuals really standing out. That things that are real turnoffs are exaggeration. The number of emails we get every day from people saying, explosive opportunity, this is huge, unprecedented, tremendous. Those are the kinds of things that we tend to run away from after reading the first two sentences. I mean, if you got tremendous, huge, gotta be the biggest thing ever, we run for the hills when we see that.
Yeah. And what if they have traction? Like, what if they said, hey, I already have a few paying customers and here's the idea and you think it's pretty compelling? Does sort of like the results kind of convey?
Yeah, results do matter. Yeah. I mean, we're usually getting involved earlier stage, but we definitely often come into a company that's been bootstrapping for 2 or 3 years, that it was like 4 founders, and they do have something real. They have they have the logos, the 3 logos that we talked about earlier, and they there's a credible business there that they've proved that's and they're ready to raise venture money and they want to raise venture money. That could be a really good fit.
Love it. Well, we'll have to have you back again, Craig, and maybe in 6 months. Who knows? The market could look real different,
Fingers
especially if
crossed. We're rooting
interest
for it.
rates come down. Yeah. Well, I will. I will keep in touch with you, sir. And thanks again for sharing your insights and wisdom. Really appreciate it.
Great talking to you, Tom. Talk to you again soon.
Take care.
Thanks.
Bye. All right. That was Craig Sherman. By the way, if you are looking for a startup attorney and you have a warm connection to Craig, like he's legit, man. Clearly, like super smart, totally not an a-hole, and has been around and knows the game. And I worked with him for many years as my attorney for my startup, and he was just always on his stuff, man. High integrity as well. So let me give you some takeaways from this conversation. Before I do that, I did want to let you all know that I have a couple of classes on Maven starting pretty soon, and I just wanted to give you a heads up on what they're about. Let me see if I can even share my screen. Yeah, here we go. Share screen. So I've got one on high impact product reviews for ICPMs. And I did my first cohort in April, and it got 5 out of 5 stars from the 3 people who filled it out. And we've got another cohort starting, and I keep the cohorts pretty small. I cap them at around 6 or 7 students, and it's very interactive. We do a lot of role playing, a lot of kind of critiquing of artifacts and things like that. So check that one out. And then I've got another one, which is business strategy in an AI first world. That one's starting, I think, that one's starting this weekend. And that one's going to be super cool. That one, I think I have 1 spot left. And we're going to look at 4 Harvard Business School AI case studies. The first one will be on the AI tech wars between Google and Microsoft and others. And then we'll do another one on GitHub, Copilot, and then I think another one on John Deere, and another one on a AI tutoring company. So that should be cool. So if you're interested in business strategy, that's a good one for you. And then if you're looking to kind of up your product review game, this one will be good for you. Okay, so now let's talk about takeaways from Craig. My read is that if you're a PM, joining a company that raised money in 2022 but has not yet found clear market fit is going to be tough, because it will be hard for them to raise their next round, because they'll either have to do a down round, which nobody wants to do, or they'll have to justify their 2022 valuation, which depends on the fundamentals of the business. So be careful about joining a company that has raised money prior to 23. Now, if they raise money, let's say after the second half of 23, then that's a great sign. That's the opposite. It's like, wow, they must be doing something right. And then for the seed stage companies who raised money this year or last year, then that on those, you're just going to want to make sure, like, okay, it is great that they raised all this money, but are they going to raise their A round next year? And are they going to be able to actually build a business, as in get people to pay them for their thing, and ideally have them pay enough to come close to covering their costs or more? And then do they have a way to get from, 3 to 30 customers or from 10 to 100? So yeah, if you're a PM, like it's a super exciting time because someone's going to make the right call. Someone's going to join a company that ideally got money after 23 and is going to fulfill the promise. But be careful. I think the biggest risks for PMs thinking about joining startups are you join a startup that's kind of walking wounded, or you join a startup that's kind of inflated seed valuation. But somebody's going to make the right call. So hopefully, the conversation with Craig was useful. If you want to, if you're watching this and you're like, wow, I like this Tom guy. That was an interesting conversation, but he's kind of long-winded, and I don't have time for these hour-long interviews. I've got good news for you. I now have a Substack, and I basically, full disclosure, I use AI to transcribe these interviews, and then I pull out the top 10 takeaways as well as quotes from the interviews. So, that's a little bit of a cheat sheet. It's not, I prefer watching the full interview, or you can listen to the audios of these interviews. But if you don't want to do that every time and you want to make sure you get some of the good stuff, just subscribe to Fireside PM on Substack, and you'll see I got this one. This one, a lot of people like this one. This Amit Fulay on his career advice. He's got a lot of good stuff here. I generally pull out 10 things from each. Here's one from a former manager of mine, Ariel Bardine. He has some really good stuff around how to be a successful PM leader. So yeah, check me out on Substack and take a class on Maven. And then if you're founding a company pre-seed and you have a great idea and you're awesome, I do angel investing. So hit me up that way. I'd love to learn more about what you're up to. I like to think that I provide value-added capital. So yes, I write checks, but hopefully you get some advice and feedback and a sounding board from me that's helpful to you as well. So that's all I got for this show. Let's get back to work.